The average American spends more money to have a money manager or a financial advisor manage their assets to make them a worse performance.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have the lifestyle investor, Justin Donald. Justin is the founder of The Lifestyle Investor and master of low-risk cash flow investing. His ethos is to create wealth without creating a job that we're going to talk about. He excels at simplifying complex financial strategies, structuring deals, and disciplined investment systems that consistently yield profitable results. We're going to talk in today's podcast about how the wealthy, how the billionaires, the centimillionaires truly invest, and he's going to share what he's learned over his years with that. And through his Lifestyle Investor Mastermind, Justin now consults and coaches entrepreneurs, executives, and successful media personalities on lifestyle investing. He also hosts the Lifestyle Investor Podcast with the aim of helping investors consistently generate repeatable returns. Justin, great to have you on the show.
Hey, thanks. Glad to be here, Chris. Excited to spend some time today.
Yeah, absolutely. I know your message is very similar to what we talk about with the audience here at Next Level Income. I'm really excited for you to talk about, the Lifestyle Investor, which is your book, but really talk about what the concept is and how you live that every day, and share that with your coaching clients, your audience, your investors, and all that. So let's hear a little bit about your background before we get started, Justin.
Sure. The term lifestyle investor I kind of coined because I wanted to capture something that I felt like most investors didn't have, right? So to me, I want to earn money to do epic things, to have a great life, to have cool experiences with family and friends and live life on my terms. So the goal is to invest in a way that creates passive income and allows us to live life on our terms, right? A life by design, not a life by default. And so that's ultimately where Lifestyle Investor came from. But the body of work that kind of helped produce it came over a much longer period of time of iterating and reiterating my investment thesis and figuring out what are good deals, what are not good deals, getting involved in bad deals, getting involved in good deals, kind of building out our investment criteria for me and my family. And then obviously we teach that to other people in the Lifestyle Investor Mastermind and community, and helping them build out their asset allocation and learning what the billionaires do and what their asset allocation looks like and what do they invest in. And it's a lot different than most people think. So, we want to kind of democratize what the wealthiest people in the world are doing from an investment standpoint, because most people think, oh, you invest in the stock market and you 60-40 equity to bond split. Now you're properly allocated, but that's not proper asset allocation. That's 100% public equities, which is super risky. And
as we've seen here, as we record this, we're recording this kind of early April, and we've watched, well, in 2022, we watched that 60-40 portfolio for the first time in history go down at the same time. We've seen investors get absolutely whipsawed so far this week, up and down, and we've really seen that highlighted.
Right.
Yeah.
Well, and it's interesting because that 60-40 split, touted as the safest asset allocation, was literally the worst asset allocation, worst performing asset allocation in a century. I think that was in 2022. And so think about that. That's mind-boggling. Yeah. And when you learn that the wealthiest people in the world, the single family offices, aka the billionaires, and then the centimillionaires and what their family offices do, you realize that really it's only about 15 to 25% of their net worth that has any exposure to public equities. 50 to 60%, and in some cases even up to 70% is in alternative investments. And they leverage their public equities. They borrow against it. So they don't have to sell them. So there's no taxable event if they just borrow. So they borrow against it and then buy more alternative assets.
Yeah.
And so most people don't get that. And so, I really wanted to kind of help bring that to your average everyday person, to your entrepreneur, to your, higher paid corporate executive or doctors and lawyers, people that A, should know this, and B, have the means to do something with it right away.
Yeah, no, I love that, Justin. I want to break down, what the ultra rich do as far as their asset allocation because we've talked about it multiple times. But one of the things I learned in sales was we used to tell our sales reps, hey, you know, people need to hear things about 7 times before it sinks
That's
in,
right.
especially when now my MBA is in asset allocation, is in portfolio allocation. And
Okay.
as I learned that in my MBA program, I was like, wait a minute, like this is not how the family offices, the endowments actually allocate their money.
That's
And I'm
right.
like, whoa, this is crazy. So here I'm learning all this in my master's program. When did
By the
you
way,
figure? Yeah, go
I know
ahead.
many
Yeah.
billionaires
Yeah.
that have less than 5% of their net worth in the stock market today,
Yeah. Yeah.
even
Yeah.
pre, drop.
Yeah. Yeah. And it's, the Dave Ramsey's of the world do a lot of good because they talk about reducing debt and things, but really I always say that's like advice for the working poor, and I think your mission is very similar, which is let's teach the masses what the ultra rich do.
Yeah. By
When
the way,
like,
I would
go
love to
ahead.
just give a
Yeah.
shout out to Dave Ramsey. I think
Yeah.
Dave is world class
Yeah.
at
Absolutely.
helping
Yeah.
people get out of debt. I think
Yes.
he's
Yeah.
fantastic at helping
Yeah.
people get out of debt,
Yeah.
but he does not teach how to build wealth.
Great point.
Two different
Great
ends of
point.
the spectrum. Someone
Yeah.
trying to get out of debt is not a candidate for the things that we do, the things that the wealthy do. They need to get out of debt first. And we need people like Dave that educate the world. Like if you're in debt, here are the processes, the programs, the ways to do
Yeah.
it. So I actually love that he does that. What I dislike is that people take it out of context and say, Dave Ramsey says this, so I shouldn't do it. He says debt is bad, and so I shouldn't,
Yeah.
invest in something that uses, a bank for a loan. But what if you get a long-term fixed rate? What if you lock it up for 10, 20, 30
Yeah.
years? What if you get a rate cap? What if you do all these things that actually makes that debt good when that asset cash flows today? So
Yeah.
I just want to, separate or bifurcate
Yeah.
this whole idea of, Dave Ramsey says don't do it. Well, it depends what scenario you're in. Like, do you have a lot of credit card debt? You absolutely should go to Dave Ramsey. He's world class at that. Do you actually
Yeah.
want to build wealth, compound wealth, create millions of dollars of net
Yeah.
worth, maybe tens or hundreds of millions? Um, a different person. It's a
Absolutely.
different education. It's
Yeah.
a different thesis. It's a different strategy.
Yeah.
And that is the world of having access. You either have it or you don't. And it's all
Yeah.
about the people you hang out with. It's all about mentors
Yeah.
and peer groups and masterminds and the connections that you have.
I love that. So let's walk our audience through that, Justin, kind of step by step. But again, I want to go back. When did that light bulb go off for you? Like when did you say, wait a minute, like this is not how you can live life on your own terms?
Well, I'm an early entrepreneur,
Yeah.
and I got to a point where I was working crazy hours because what I learned was, okay, over here, I can be an employee and I can make so much, but I kind of get capped on what I can make for the
Yeah.
most part, right? There's only so far you can move up the corporate ladder. I actually learned that I don't want to move up the corporate ladder because it just kind of creates more, golden handcuffs.
Yeah. You
So,
get
I
tighter,
opted
tighter and
to,
tighter, and that chain gets
that's right.
stronger and stronger. Yeah.
So I opted to build a business and I liked it because I could work hard and earn more. The
Yes.
problem is if you don't build the systems, don't, have the right infrastructure, don't have the right people and teams, then you can be on the hook to do a lot. So early days I was on the hook. I
Build a
was
job. You
working.
build a job,
Yeah.
not a business, right?
That's right. Your business owns
Yeah.
you. You're not a business
Yeah.
owner. Your business owns you and lived that, right? And
Yeah.
so I learned to build better systems. I learned to hire better people and that created a better framework. But I remember in the early days putting in the hours, it was great because then my skill set wasn't as developed as it is today. So what was I really good at when I didn't have a strong skill set elsewhere? Work ethic. So that actually served me really well, Chris. I worked my tail off, but in the process of doing that, I actually acquired skills. And the smarter I got, the more I realized I should not be banking on my work ethic. That was good that I had it, and it's good to know
Yeah.
I'll fall back on it. But that was kind of like phase one.
Yeah.
Phase two is how do I use my intellect? How do I leverage relationships? How do I build systems and create replicable processes inside the business and inside of investments? And so now I don't work as hard. And I've figured out how to make more working less hours. And so,
Yeah.
that little difference, I think, my first aha was, wow, I used to wear work ethic as a badge of honor. I need to
Mm.
wear intellect and networking and relationship building as a badge of honor. And that really is how I should kind of grow what I'm doing. But I did have one, well, many, but one distinct late night.
Yeah.
I can't remember if it was a Friday or Saturday night. It was on the weekend. My friends were out and they were all going to the bars downtown. I lived in Chicago at this time. And
Yeah.
I just remember thinking, you know what? I'm okay with this season of life right now. I'm working harder. I'm not going to make it.
Yeah.
I'm staying late, at the
Yeah.
office that night. I'm be in early the next morning.
Yeah.
Back then I was working 6 days, 6.5 days a week.
Yeah.
So I knew that that season was there, but I also knew that it was temporary. And so the realization was, I can do this and I'm willing to do it today. I most certainly will not do this when I'm
Yeah.
married and when I have
Yeah.
a family, when I have,
Yeah.
my daughter today, who I want to attend all of her sporting events and I want to be
Yeah.
at all of our family dinners and all that stuff, right? That matters more. So I knew that I needed to figure out and bridge that gap. I didn't know how. I just knew I
Yeah.
needed to, and I figured if I read enough books, if I surrounded myself with the right people, if I had the right mentors, I would be able to figure it out, and that is ultimately what came into fruition.
Yeah, I love that. And you mentioned several things that I think are important. We have a lot of professionals that are out there, doctors, surgeons, like the people I used to work with, professionals, as you mentioned, they work up, oh, they're vice president, they're president. I was talking to a friend, coaching client, makes 400 grand a year. His wife makes 400 grand a year. And he said that he's like, man, I don't see my family. I don't see my wife. There's cracks starting to form in my relationship, my as a husband, as a father, and he's trying to figure out what do I do to get out of this because working harder and working more got him where he is, but it's actually putting him deeper into that hole as those golden handcuffs get
Yeah.
stronger and stronger. Go
Chris, I,
ahead.
I learned a
Yeah.
valuable lesson early on. The lesson was this: there's a choice, and basically, what happens. So there's two different, lessons that I learned here
Yeah.
from two different people, and one of them is whatever you're saying yes to, you're saying no to everything else. So if you're saying
Yeah.
yes to business, yes to work, yes to growth, then you're saying no to your family. And which is the
Hmm.
greater cost, and
Yeah.
and sometimes for us, alpha males and hard charging, men and women, it's like, oh, I can justify it, but is that actually what's best? And when I learned to put boundaries around my time and the business and
Yeah.
what was non-negotiable with my family, everything changed. And I actually thought I was going to do less business, so I decided I'll say yes to my family
Yeah.
and no to extra hours and all the different stuff with work.
Yeah.
And I thought business would go down, but I would be building, relational equity inside my family, right? Like I'm doing the better things. What ended up happening in reality is I just got more efficient in the business. I got more efficient with my time. I got better at delegating. I got better at um, putting the right people in the right seats. And so I actually worked less in the business, and the business started to grow more than when I was doing all the things, wearing all the hats. But
Yeah.
it was described to me as this: your business is a rubber ball, and your family is a glass ball. And most
Yeah.
people drop the family ball
Yeah.
and it shatters. You,
Yeah.
you can't put it back together. 10 years later, you can't make up for that lost time
Yeah.
of missing events and connecting and family dinners and being at all
Yeah.
the things. But the business ball, that's a rubber ball. That thing keeps
Yeah.
bouncing. It might stop bouncing. You can get it to bounce again, right? Like it's
Right.
it's
Yep.
so resilient.
Yeah.
And so that has just really spoken loudly to me over the years. And I'm thankful for those lessons because I chose family. And I did it at thinking it was to the detriment of the business, but in reality, actually ended up being to the betterment of the business.
That is such a great analogy. I love that. I used to juggle when I was like super cool when I was in math club and in middle school. Like I juggled and I like did math. I was like, okay. I was in the marching band too. I put some, um, but no, it's great because you drop that glass ball, you can't pick it up. Have you read the book Die with Zero?
I have.
Yeah,
Yeah,
so a lot of similar lessons in there. It's a
that's
little
right.
it's a little hyperbolic to say die with zero, but it's like, hey, what are you like? What are you living for? I've talked about the moment where I lost my best friend in college, and I was like, wait a minute, like I was racing bikes at the time, Justin, and I was like, I realized I was riding around in a circle at this race one day, and it just dawned on me. I was like, what am I doing? Like, what if I die tomorrow? Like, am I going to be happy with what's happening? And I got smacked into the face with the death of my friend. And I hope, I hope people don't have to go through that to realize it. But the bigger thing in my mind is a lot of people don't realize that till they drop that glass ball.
That's
They
right.
lose their marriage, they lose the relationships with their kids, or something happens with their kids because they don't have that time. Um,
Yep.
when did you, so you had a business. What type of business was that?
Well, I had a recruiting and sales company early days. I
Yeah,
turned that into a consulting company and kind of spun
yeah,
out, the consulting arm and advisory
yeah,
arm. Started a single family home maintenance company that ended up doing business with the large institutional owners of single family homes
yeah.
once I started noticing the pattern that was becoming a real estate asset class. Because back then,
Yeah.
SFR was not a thing,
No, it's just what
people,
people, it's like what my parents did. They bought a couple
yeah,
and, ran them.
that's right.
Yeah. What's the percentage now? I mean, we see the BlackRocks, we see the private equity groups buying up, single family homes. So we've seen that since the great recession here in
Yeah,
the past
they've
15
scooped up a
years.
ton. I
Yeah.
don't know what the total concentration is today. I
Yeah.
just know your biggest groups are, 10,000 to 9,000 single family homes. I think
Yeah.
you have one group maybe approaching 100,000 single
Yeah.
family home rentals now.
Yeah.
And so our business serviced that. And then while
Yeah.
we were doing that, I started building out our real estate portfolio. And I got started
Yeah.
with mobile home parks, got into
Yep.
apartment complexes, got into hard money lending, then transitioned into industrial. But I mean, I've done it all. I did retail, I did self-storage, I did office. I mean, you name it, I've done it. But my largest two holdings today are still mobile home parks
Yeah.
and industrial real estate, which have been the
Yeah.
top two performing real estate asset classes this past decade.
No, it's been fantastic. So, for those people that go out, they've created a career, they've created a business, they have capital coming in. Let's say they have debt to pay off. They listen to the Dave Ramsey's. Let's go back and talk about, like, how do the billionaires allocate compared to that traditional 60/40 portfolio in stocks and bonds?
Yeah, I mean, we'll just start with the stock market.
Yeah,
Seen as low as 5%. I've seen as high as 30%. So I just
yeah,
generally say most of what I see is 15 to 25% in the
yep,
stock market.
yep,
Some sort of, I mean that position is generally going to
yeah,
be the stock side of things.
yep,
Okay.
yeah,
Generally, you see 5 to 15% in fixed income. So that's going
yep,
to be more the bond side of things.
yep,
And then you'll see, really alternative investments are about 50 to
mhm,
60%.
yep,
And it's been an uptick. So,
yeah,
2020 to 2021, 2022, so on and so forth. Every year that has grown
yeah,
over the last 5 years. And so when the report comes out, there'll be a new report out in May this year for all the family offices. So JP Morgan, Goldman
yep,
Sachs, KKR, Apollo, Merrill, like all these groups will put out their reports. The family office groups will put out their reports. So we'll know 2024 numbers here, in the next month or two.
yeah,
And I study this data like crazy. All right. So private credit, you're seeing that creep up. And
yeah,
so you're seeing
yep,
that one, a lot more like 5 to 10, maybe as high as 15%.
yep,
You're seeing crypto 1 to 5%. And that's primarily Bitcoin.
yeah,
Your younger family offices are probably a little more aggressive with other, I mean, crypto in general, they might go up to 10%. I've seen as much as 15%. Um, and then you've got, cash. That's generally 5 to 10% cash or cash equivalents.
yep,
You've got real estate is generally mm, usually like 10 to 20%, but I'm seeing it a lot now, closer to 15% or so.
yeah,
And then, and then you've got like your lower percentages, like, Oil and gas,
Hmm.
commodities is like 1, 2%. Infrastructure is 1 to 2%. Precious metals is 1 to 2%. Collectibles is 1 to 2%.
Hmm.
Most
Yep.
of those probably floating closer to the 1%, right?
Yeah.
And that's probably everything in there. I think I said everything, but
Yeah.
that's mainly it. It adds up to 100%.
Yeah.
But I think when you take out private equity, private credit, real estate, and some of the other alts like crypto and oil and gas, um, those five categories are generally anywhere from 50 to 60%. And then I
Yep.
actually just went to a family office event where there were families that had 70% exposure to
Yeah.
alts.
Yeah, and I think and also I think the one you didn't mention is there's like businesses. I think a lot of people either own have their business allocation from the business that they built and created their wealth, or they're investing in smaller business. I know that's part of your portfolio as
Yeah,
well.
generally
But
that'll fall in private equity. And you're right, I
yeah,
did not say that. So private
yeah,
equity is generally 20 to 30%.
yeah,
And the
yeah,
purists will actually
yeah,
separate out their business versus other
yeah.
private equity they've invested in. But yes,
Great
that
point.
that
Yeah,
is
great
so the
point.
biggest
Yeah,
one of alternative investments is private equity.
yeah,
Venture would fall into that, and that's
yeah,
generally like 4 to 10% of that
yeah,
20 to 30%. And then, the rest of private equity businesses, small mom and pop stuff, or big companies owning a smaller position. That's the additional, up to about 30. I mean, I've seen it as high as 40%, but,
yeah.
generally you're seeing 20 to 30, maybe up to 35%.
Yeah, and that's a great point. So just kind of contrasting that, you got, the average investor that starts out, they're putting money in their 401k, they're doing like the traditional 60/40, 80/20, 70/30, 50/50 portfolio stocks and bonds. Whereas you get in the ultra rich categories, you mentioned the centimillionaires, the billionaires, they're doing like a quarter maybe in fixed income, which may be bonds, it may be other type of fixed income. And then that big one that a lot of people miss is the 50% that you just talked about and broke
That's
out
right.
for us.
Most people
Um,
don't even know that's a thing, right? I mean, they're
yeah, no,
they're listening to their
yeah,
financial advisor, and
yeah,
their financial advisors incentivized based on assets under
yeah,
management. So whenever there's a good deal that they don't make money on, they typically don't like it, right? And
yes, yeah,
and then just to put this out there for those that have people managing your money, in the last 15 years, only 5% of all money managers have outperformed the S&P 500 index.
yeah,
In the last 30 years, it's less than 1%.
yeah,
Less than
yeah,
1%.
yeah,
Meaning the average American,
yeah.
the average American spends more money to have a money manager or a financial advisor manage their assets to make them a worse performance.
That's a
95 to
excellent.
96 or 99% of them are spending more money. So they're draining their net worth. They're spending more money to get a worse performance than if they just went on Charles Schwab and invested in the S&P 500 index.
Yeah. Excellent point. And I just read a report 2 days ago. Average investor averaged over the last 20 years 3.5%
That's
approximately
right.
in
There
the
it
stock
is.
market. And then Burton Malkiel, one of the first books I read on investing, A Random Walk Down Wall Street. He infamously talked about like a blind monkey throwing darts, or a monkey throwing
That's
darts
right.
can pick better than your average manager. And
That's right.
if you think about it, it makes sense, right? Because all of these managers, all this money makes up the market as a whole. So all you need, if you can capture the market performance, if you're paying somebody to do that and then you're paying fees on top of it, you end up eroding your performance.
That's
And
right.
you're most people don't think about it, but if you're getting a 10% return and you're paying an average of 2% in fees and everything on top of it, you're giving up 20% of your performance, but in a
Before
compounded
taxes.
effect before taxes, and then that compounding effect,
That's right.
you're just average investor that's investing, 1, 2 grand a month. You're spending seven figures over your 40-year career in
That's
that
right.
underperformance, unfortunately. So two big things that you mentioned is lowering fees can help your performance, and the proper asset allocation, as
That's
you
right.
mentioned, Justin. You've invested in businesses outside of your primary business. What type of businesses have you been involved with?
Well, I have this philosophy that I don't like to do any sort of early stage or risky investing unless it's with surplus cash flow. So for me,
Yeah.
First and foremost, I need to cover my survival income. So what does it cost me just to
Yeah.
get by
Yeah.
on a monthly basis? Then get to my lifestyle income, what it costs to actually live the life I'm living.
Yeah.
Then it could be like, what's the ideal lifestyle? Like, how do you want to be living? Now, I feel like I'm living pretty good, so I just try and build this big plus over lifestyle.
Yeah.
And then, for most people, they're working their whole lives to save 10, 15, 20%. Once you get to surplus income, you can take 100% of that and compound wealth or, donate to impact and things that make a difference. And so,
Yeah.
so that surplus income, so I don't need any more cash flow to cover my life. What's additive? I take
Yeah.
that, whatever is monthly recurring or quarterly recurring, and that's where I invest in earlier stuff. So early
Yeah.
stage companies
Yeah.
are higher risk.
Yeah.
I mean, generally the numbers tell you that you got to make about, I mean, at a minimum 50 early stage investments to have a winner, and
Yeah.
usually it's closer to 100.
Yeah.
And you actually need to invest in 412 investments, or you would have a unicorn.
Yeah.
So think about that. Most people never get to those numbers. So they're basically
Yeah.
giving you know, an interest-free loan for an undetermined period of time, and they don't find out that it went belly up for 10, 15, or 20 years. And that
Yeah.
time they were probably doing more of those investments. So
Yeah.
I really like to keep early stage to about 1% of my portfolio.
Yeah.
Venture, I like to have at 10% of my portfolio with professional managers that know, I shouldn't call them money managers, professional venture capitalists
Yes.
that are tier one outliers, best of the best, top quartile performance. And then I like large positions and small to medium sized businesses that have a track record of profitability that I think can easily be enhanced and um, even systematized or
Yeah.
adding a layer of technology to help increase the valuation, maybe adding a layer of AI to it, or taking smaller positions in much larger companies.
Yeah.
And I like profitable companies. I don't put any more than 10% of my net worth in early stage. And really, it's 1% in early stage.
Yeah.
It's 10% in, mid stage, so Series A and beyond.
Yeah.
And then it's the additional probably for me 25% in late stage. So I'll do
Yeah.
secondaries. I'll buy a business and bring in an operator. But I'll do secondaries of big, companies, or I'll do, and then I'll follow trends too. So like
Yeah.
AI, I know it's going to be big. I don't know who's
Yeah.
going to be the big one. So I
Yeah.
just invested in all. I invested in Cohere,
Nice.
Anthropic, X, Perplexity. Um, uh, there's a few others. I
Yeah.
don't know who's going to be the winner.
The
So,
AI, yeah, the AI
oh,
basket, just like,
OpenAI,
yeah, yeah,
ChatGPT,
open it,
yeah.
yeah,
So all
yeah.
five, I've
Which I
got
just
to.
saw my son was on this morning. He's 15. I'm like, these kids are writing papers with ChatGPT, and then they're running them through another filter that, it creates a algorithm that doesn't allow the filters, the tests to detect it. It's pretty wild.
That's
So,
right. By the way,
um,
I'm also
yeah,
going to say though, I don't know. I mean, I know AI is here to stay. I don't know
yeah,
which company it is,
yeah,
and really, you only have to get one of them. But I only make those because they're still early stage investments. They're big companies,
yeah,
but they're still
yeah,
like, early to mid stage investments. So
yeah,
I still like that being from the cash flow of my surplus
yeah,
income.
yeah. Great point. And that's um, anti-fragile Nassim Taleb. He talks about that, like that bar, like you gotta be safe on one side of the spectrum, and then you can bet big with that very small percentage on the other to have
That's
a
right.
very robust portfolio. Justin, you talked about the top performers here over the last decade. You talked about mobile home parks. You talked about multifamily. What do you see being top performers in the real estate market over the next decade? Because we've gone through a lot of volatility here. We saw coming out of COVID, we just saw crazy valuations. People were making crazy returns in those markets. We've seen a lot of challenges on the credit side right now, and we're seeing a lot of shakeouts there. What trends are you following over the next decade on the real estate side?
So specifically real estate, I'm
Yeah.
still very bullish on mobile home parks and industrial. Those are my two heaviest holdings. They're going to continue to be my heaviest holdings. I like them the most. There's more data on industrial because it's bigger and it's more institutionally owned.
Yeah.
Mobile home parks, there's less data because it's less institutionally owned.
Yeah.
It's the least concentrated real estate asset class.
Yeah.
But that
And when you
generally
say
gives,
least concentrated, you're talking about there's still more mom and pops, more disparate ownership in
that's
that
right.
versus more institutional ownership. Yeah.
That's right.
Yeah.
Yeah, it's still probably 10 to 15%, maybe max 20% institutional ownership. So,
Yeah.
so because of that being the most efficient real estate market, that likely will be the best performing.
Yeah.
But with industrial, it's just going to continue to grow. E-commerce is going to continue to grow.
Hmm.
We're going to do more, onshoring here. I mean, it's
Yeah.
just going to continue to grow. So those are my two that I'm really banking on. But if you want a big picture,
Yeah.
um, and think about the trends, because I've made a lot of money on trends. I got into mobile
Yep.
home parks early. I got into industrial. I got into cannabis investing early. I got into the single family home rental business early before it was ever even deemed an asset class and established to be tracked. And so what I'm trying to do is figure out what's the next thing that is a trend that's not
Yeah.
mainstream that I can be early on. And so like a lot of people don't know. I mean, today AI is really big and robotics is really big. I've been investing in them for a decade. So
Yeah.
like I knew that that was going to be big way back when. And so I'm looking for what's the next thing that's going to be really big. And the reality is the largest wealth transfer in the history of the world is about to happen. It's happening over the next 5 to 15, maybe 20 years. And that's with baby boomers
Yep.
passing down their wealth to millennials to the
Yep.
tune of anywhere from, I've heard, 80 trillion to $106 trillion.
Yeah.
So even if you take the low end of that,
Yeah.
that's by far the largest transfer of wealth in the history of the universe.
Absolutely.
So, what do millennials like? How do they spend their time? How do they work? How do they shop? I mean, there's data for all this. So it's not like you're just guessing and throwing darts.
Yeah.
You actually can
Demographic
figure
trends.
out
Yeah.
what they
Yeah.
desire and invest in those things.
Yeah. You ever, are you familiar with Harry S. Dent?
Yeah.
Yeah, I read his stuff when I was in business,
Oh,
actually
yeah.
right before business school, and he talked about how you can predict baby boomers' purchase of Harley Davidsons and potato chips and houses, and that's one of the reasons I got into multifamily and the medical device space with all those things. I think we're going to have a real crisis in senior housing right now, over the next decade. Is those baby boomers are going to age up. They're going to need to be cared for. I'm dealing with that with my stepfather at the moment, as a matter of fact. Any
And it's
thoughts on that?
expensive. It's
It's
really
do you
expensive.
want to? Yeah, you
So
want to go into some
there's
numbers? Yeah, we're
limited
talking five. Yeah,
resources and it's
yeah,
astronomically high in
yeah,
price.
yeah. It
I don't know
really
the
is.
data on
Yeah,
it the way you do.
yeah,
I've studied a lot of other
yeah,
things,
yeah,
and
yeah,
that is one sector I have not
yeah,
actually invested in. So maybe one of the only real estate sectors I have not invested in.
yeah. Well, there you go. Now you can at least research it, and we can have you back on and chat more about that. But I know you're wrapping up. I know you got another podcast you're going to be recording here. I'd love for you to share a little bit about your book, your coaching group, and I think you got some cool stuff you're going to share with the audience as well.
Yeah, so you can find anything I do on lifestyleinvestor.com. So the goal is to have something for everyone. So I've got a podcast called The Lifestyle Investor.
Yeah.
That's obviously free. I've got a blog. I've got all types of free downloadable resources.
It's
Some of
fantastic. Yeah.
what I wrote in my book, I decided to exclude from the actual book. So the only way you can get it is these downloads, and it
Yeah.
is literally book level quality. So of course there's the book. We just launched the updated and expanded edition of the Lifestyle Investor. So we added a 30% more content to that book from the previous book.
Oh, awesome. Yeah.
And so that book became a #1 Wall Street Journal and USA Today bestseller. It's a top 1% of books sold in the history of all books, which is super flattering. All the proceeds go to fight human trafficking. So we've donated hundreds of thousands of dollars to those efforts and feel just a strong calling to really shining the light on people that are needing our help more than anyone else. So from there, we've got online courses, we've got master classes, we've got a tax strategy masterclass called the Tax Advantage. We've got a due diligence course where we teach people how to actually invest in real estate syndications, real estate funds. We've got a passive income masterclass. We've got a mobile home park masterclass. But our flagship product, I mean, we run a couple of live events, but our flagship product really is mastermind. We've got a couple of different masterminds, depending on where someone qualifies. But this is kind of like the highest ticket, most value opportunity between the lifestyle investor tribe of investors. And it's just been a lot of fun. We've got a wait list on Lifestyle Investor, and they've both just seen tremendous growth over the last number of years. So any of that can be found at the lifestyleinvestor.com or just lifestyleinvestor.com. And what I wanted to your audience, we do these strategy sessions for people that kind of want to figure out, how do I take the next step? Like, how do I move from point A to point B or from point B to point C? And so we do these $500 strategy sessions. But what I'd love to do for your community is just open up and say, hey, anyone that wants a strategy session, we'll do it for free. So we'll waive the cost. And you can meet with someone on our team that is skilled at, really helping people, coaching people to figure out what's next. So if you go to lifestyleinvestor.com/consultation, you will obviously be able to schedule a time for that.
Awesome. And we're going to put that in the show notes here. We got your website in here, Justin. We got that link for the audience. So if you're listening today, click on that lifestyleinvestor.com/consultation if you want to meet with someone from Justin's team, and check out your book. It's fantastic. The community is fantastic, Justin. We love what you're doing. And thank you so much for sharing your thoughts and your framework for developing wealth, as you said, so you can live life on your own terms and do epic stuff.
I love it. Love it. Well, thanks so much, Chris. It was great having, the day, some time spending with you, and even learn a little bit more about the cool things you're up to. So really cool that you spend the time, hosting a podcast so you can educate your network and your audience on just better ways to live and invest and help people learn lessons from those of us that have made a lot of mistakes along the way. And I've made tons of them.
Indeed. Well, Justin, thanks for sharing that. Thanks for all that you do, and have an amazing afternoon.
Thanks. You too, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.